a verified trader with over 10 years of experience and showcasing transparency with over $1 million in profits on his own personal capital.
The biggest reason for some of the success I've had is to eliminate noise on shorter time frames. If it's not a previous day high or previous day low where I know major inflections happen, I'll typically not even look for the setup. There's thousands of lines you can put on a chart. You have to be able to minimize what you're looking for and not going to just chase something just to take a trade.
This episode is all about simplified strategies, risk management systems, and realistic expectations, even from someone who's made $1 million plus within the markets.
When a blackjack player counts cards, they know when the table's hot, they know when the table's cold. They go, okay, I'm back to minimum bet. I think the count's cold. It's hot. I'm going double bet size, triple bet size. I take that same approach to the market. When I think something is hot, the momentum is there, and the retest and the structure is very clean, I have to be getting aggressive. An example of this is I think it's helpful for new traders to let a side develop. So if you have your structure high here, structure high here, I'm not going to look to short this structure high until you've broken under this one and retest and reject it. I'm not guessing up here. If anything, I'm still going to look for pullback longs in that trend. But if we break that, then I know we've lost that structure and I'm going to start to attack the reversal trade.
It's easy to fall into traps, but that's why they're traps. Otherwise, no one will trade them or fall for them. What are obvious traps that it's just easy to fall for from beginner to experienced?
For me,
ladies and gents, welcome back to another episode. I'm excited to have a technical deep dive today with a man who's been in the markets for 12 plus years. Before we get into your journey, the penny stocks and how you navigated a decade in the markets, I want to jump right into technical. So if you can give me a bit of a summary on how you view the market and what are the confluences you're looking for?
So every day I step in, the first and foremost, the most important thing that I'm looking at is S&P and NASDAQ futures levels. That's everything that I focus on. So any trade I take, any idea I create, it's all based on my technical analysis on the futures contracts. So even though I'm an options trader, options is just the vehicle that I choose to trade. But I strongly believe that everything is running off of that futures contract. So I'm stepping into the day, I'm creating my key supply and demand levels, my key inflection points on the ES futures and on the NASDAQ futures. And I'm creating a thesis based off the levels on those contracts, right? So stepping in today, 59.20 on the S&P was a key previous high from this week. That was the double top high that we continued to reject over the last few days. So I'm walking into the day and I'm understanding if I'm too close to 59.20, I'm not looking for a long, right? Because I'm too close to that previous rejection point. There's no risk reward to long into this known rejection point on the futures. And if that rejection point comes in, then I understand I'm not going to be looking to long Tesla or Nvidia or Apple, because if S&P rejects, if NASDAQ goes with it, individual equities are going to follow, right? So I'm creating that thesis of where I want to long the market, where I want to short the market, where I want to follow that with individual equities based off those futures levels.
How are you defining your levels? So you mentioned kind of previous reversal points. So let's say support and resistance. What else is defining key levels for you?
It's pretty much all just previous reaction points. So it's not just short term, right? So I'm not going to just look at what was yesterday's high. It will come into play because we see small moves. As a scalper, as sort of a short term trader, we'll be able to notice inflection points from maybe just a previous day high, previous day low, and play off that. But 59.20 on the ES was one of the previous major rejections from back in 2024. So I'm making sure to always zoom out. These levels are created on the 4-hour chart, mostly daily charts. I try not to get too in the weeds with like short-term levels because you can create 1,000 levels. Here's a rejection from last Tuesday. It's all major spots. So Liberation Day was that Trump day that was created, right? That was around 57.70, I believe. And I'm sorry, I think it was 57.70. And that was a major inflection point for the market. We had a huge push, a monster rejection. That's where we saw most of the downside come in over the last few weeks. And so I know if we're trading back into that high, this is going to be a major inflection point, somewhere that we've seen a lot of volume come in, major liquidity sitting there. So I'm basing my thesis off of these spots.
When you have key levels, as you said, on a higher time frame, multiple rejections, they become very obvious. And as you can see them, also everyone else can see them.
Absolutely.
And often these levels can be very well respected, but also pockets of manipulation can happen.
Absolutely.
How do you navigate these areas where I can see you're not going to buy up to the resistance because there's not a trade there,
right.
or you don't want to immediately sell off because you don't know if there's a reversal yet.
Right.
But when you're entering the territory of a level like that, what is your playbook?
So these key levels is not so much an entry confirmation, right? This is like okay, now I'm actually interested, because I would say 95% of what people look at on the market is noise, right? It's like, oh, we're in the middle of two big levels. There's not really an edge there, right? So I use these key levels so that I'm making sure I'm only choosing to get interested when the market is approaching those spots. Now, that's just a place to look for a trade. What I'm actually looking for to enter a trade and have entry confirmation is the break and retest. So I'm strictly a break and retest trader off of these key levels. So it's short term, but also I'll take larger term trades based off the break and retest. Looking for a break above. Let's say today, for example, we had 21,420 on the NASDAQ futures. 21,420 was a major spot over the last few days. Today, perfectly, we break above that level. We start to consolidate above it. So I'm usually watching the 2 to 5 minute candles. I'm watching how the price action looks above that key level. If I'm seeing the ability to hold above, and I'm seeing whether it's wicks on the bottom side of the candles showing buyers holding above a previous rejection point, I'll then be able to enter that trade, and I'll be able to actually outline and structure my stops and outline and structure my whole game plan, right? Because if I'm playing off that level, I'm seeing a hold above that level, I can now be able to identify where my stop should be, where it invalidates, right? And where my thesis no longer is valid and where I need to potentially exit the position. But absolutely, around these levels, you have to gain experience learning how manipulation comes in. All the time, you'll see it hold above and then fail back under and trap buyers above. It happens all the time.
Do you incorporate trend into this? So, for example, let's say you have a key level. For simplicity, let's just call it support and resistance.
Yep.
In a bearish market, as you're approaching your support, you might then look for a break test to then continue in the direction of the trend.
Absolutely.
But then if you're approaching a resistance, the break test is now counter trend in a bearish market. Are you factoring in just break tests on key levels, or is trend coming into the mix?
Trend, 100%. So in an uptrend, so like the last, I would say 2 weeks, we've been in a sort of medium-term uptrend. I will only look for pullback longs.
Okay.
I will not look to short upside rejection points in an uptrend. I will only wait for us to pull back to a previous high. So if we have a previous high a day, we break above it, I'm looking for that pullback to that previous high a day to long in that uptrending market on a macro view. In a downtrend, I'm looking for a fail below, sort of break and retest rejection. And I'm following the macro trend with the shorter term trades. I never want to be on the short side in a strong sort of irrational bullish trend. I think it's probabilities are against you. And even though there might be like a intraday downside move that could be nice, I would rather let that pass by and look for what the deeper pullback would be where buyers would step back in. So definitely I trade short term, right? I'm looking for entries in like the 2 to 5 minute time frame.
Okay.
But I'm much more focused on creating a thesis on an hourly 4-hour time frame. I want to make sure I'm trading at key inflection points.
With a trend naturally comes points of interest. If we're talking market structure, where you have your daily zones, but then the internal structure down to M15. So you can have multiple levels. When you have multiple market structure levels combined with multiple time frame based support and resistance, you can very easily end up with 10 lines on your screen in a short window. How do you find relevance in multiple valid areas?
So I would say the larger time frames really, to me, show the picture quite well. And maybe this just comes from experience of charting these levels. I do it every day, do it live every day. And I will try to avoid any noise on like a 15-minute level or anything like that. I think the biggest reason for some of the success I've had is to eliminate noise on shorter time frames. It's really like my thesis every day is created on 4-hour levels, pretty much, like almost 90%. I will really not focus on some kind of 15-minute level that was held, or if it's not a previous day high, or previous day low where I know major inflections happened or a major 4-hour level, I'll typically not even look for the setup. I've noticed over my last, say, 5 years, in the last 5 years, my ability to minimize what I'm actually looking for has greatly improved my success. It's just removing, there's thousands of levels and thousands of lines you can put on a chart, but you have to be able to minimize what you're looking for and accept when something is, it's great because you can accept when something's not setting up. And actually, I think it's quite rewarding when you can say to yourself, I don't like anything right now. And I'm mature and not going to just chase something just to take a trade.
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry. And in the last year, they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there's going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital.
Yeah. When you have this resistance level, which maybe is overlapping with the supply zone, the supply zone is going to be telling you, look for sells. The resistance, you're waiting for the break test to buy.
Yeah.
So you're in these, as you worded it, inflection points where the market from this 10, 20 point range is going to lead to an expansion in one direction or the other. And it might manipulate high and go lower, or it might do the break test and continue higher, which is probably where your lower time frame reads come in.
Yeah.
What exactly are you looking for in these key zones where you might be looking to sell or looking to buy, depending on the move, depending on the lower time frame?
Yep.
What is the lower time frame read, and at what point does that begin? From how do you exactly jump down?
So when I step into the day and I have my larger time frame levels, and if we start to approach one, I have the box which is green or red on my chart, right? So what I try to do is, if the chart is black, if it's trading where the chart is not colored, I will not get interested, right? And this is like a trick that I play for myself. So if we're not in like a green area or a red area, which indicates a supply or demand area, I will try my best, because obviously we all sometimes make some mistakes and get a little clicky on the mouse, but I will try my best to not be putting risk on.
And these boxes are 4-hour boxes? Or?
These are 4-hour boxes, but I'll take it from the 4-hour and make sure I'm getting down to an hour, getting down to 30 and refine it. And I'll also refine it intraday. So today I had 59.27 as a key level on ES. And then intraday today, looking at short-term timeframes, it was clearly 59.20. So it was about a 7-point discrepancy, what I originally had. So I'll read an intraday, like today, and I'll say, okay, market's clearly showing me that we've held 59.20 multiple times on a retest, and I'll refine that level. Whether I put a box between the 7 points, right, or I'll just move the line exactly to 59.20, I'll play with it, right, as I see price action develop. Because really, what we're trying to get an understanding of is, where is the price action developing? I would say from a Monday into a Friday, things refine, right? As the week goes on and as you trade near these levels throughout the week, you can start to refine where it's actually reacting, right? When you start a Monday and you say, okay, this was a last week high, and we start, let's say we're trading around that for 2 or 3 days this week, we can start to see price action developing and see, okay, where is the actual seller coming in? And start to refine that spot.
So these let's say you've taken a 4-hour zone, you refine it down to an M15.
Yeah.
And now Monday through to Friday, you're just watching. And you're watching when the market is ready to show its hand.
Yeah.
Are you looking for just simple patterns of just rounding off, momentum slowing? Or are you looking more, let's say, what you're doing on the higher time frame down on the lower time frame? So you're finding your key levels again and waiting for those to pop or respect.
So what I think this answers your question is, I'll try to create something I like to call like a no trade zone. So like a channel that we've created. Okay. So this week we've created a pretty clear channel, trading sideways between, I think it's about a 50 or 60 point range. And I'll only look for outside of that range. And so if we're in that range, I will not look to sell the high back into the low. I will not look to long the low back into the high inside of a tight range. I will stay away from that. I with options especially, you can't get involved in trading a channel. With futures, I think it's better because you can take a 6-point, 10-point scalp and make good money. But with options, you need that expansion. You need that continuation. These contracts need direction to appreciate. So what I've tailored is if it's too tight of a channel, I'll stay away. If it's a break above a channel high, that's like a weekly high or a weekly low. If it's been a channel trade, which it has been lately, quite often, you get these expansion periods and then you get these consolidation periods, just how the market should trade. But when we're in those expansion periods, we want to attack. When we're in those consolidation periods, we want to stay away from that consolidation.
When the market is consolidating and then soon after it transitions towards expanding,
right?
What do you see as the vehicle that allows it to go from consolidation to expansion? Yeah, specifically in technicals.
I would say a lot of participants trying to short it back down. Okay. So a lot of people placing sells, looking for like, oh, this is too high, and just trying to be against the trend. And then, right, those participants being stopped on a push through that high, definitely fueling it. I would also say this week in particular has been very fundamentally driven. There has been a lot of developments with the president and China trade deals. So
Saudi at the moment, yes.
Yeah, Saudi, like that was pretty big. I think this week in particular has been one of the, you don't get this feeling often, but this week in particular has been one of, and I don't want to sound egotistical, but one of the more no-brainer upside moves in the market.
I think so.
I mean, it's been very clear that the tensions that have been happening in this year so far are starting to die off in the markets outside of technicals, right? Because I know we're talking about technicals, but there's more to it, right? It's understanding market conditions. If you're experienced, you start to get a feel for where periods of risk-on environment is, where it's not, and you can start to feel like that curve starting to decline. And so we were in the heat of panic, the heat of emotion for a pretty long time. But I think if you've been around the block long enough, you know that was always going to tamper off. That's just how the game plays, right? So like everyone goes into a panic, everyone starts forgetting about it just naturally. Like, oh, what? I don't even care about that anymore. The market starts to not care about negative news. It starts to be like, okay, we're over that. Let's go back to going straight up all the time, right? And so this week has been sort of that. It feels like that week where a lot of panic and emotion has come off the table, and the market structure to the upside has been very clear. I mean, almost the entire week you've had breaks of previous highs, retests, and continuations. I mean, it's just been a beautiful structuring higher move.
So this was actually going to be my question of when you have a fundamentally driven opportunity, the break retest seems very, maybe at times the only way to get in, because the market's not retracing. It's just going from level, breaking it, bouncing to the next level, and that's just heavy expansion.
Right.
And at times it might be like, I wish I got in earlier, or let me just get in with not a retraced, discounted entry.
Right.
But in other market conditions, I'd say more normal is price will, do an expansion, come back to the 50, come back to the 70, deep retracement, and then continue. So those break retest, is it more so for very strong trending markets, or can this apply?
I would say yes. I would say that is a downfall of what I trade. And I'm open to talk about the downfalls because every strategy has downfalls. The break and retest, options trading in general, and how I trade it, definitely is better in a trending market, in a strong fueled trending market, whether that's downside or upside. So I love it because, I'll get a call from my father and be like, the market's been going down. Are you all right? I'm like, yeah, I'm all right. This is exactly what we need. Like, we need people to be on the phone saying, oh, have you seen the market going straight up or straight down? That's my time to strike. In dull market conditions, that's the worst time for me. So we went through a pretty dull period, end of 24, maybe mid 24, like sort of end of 24, where every day would just be sideways, really no breaks, no major breaks of key levels, staying within the weekly range. A market within a weekly range is terrible for me. It's not what I'm interested in. And the goal is to tailor and to control myself enough to not get involved in that.
I've seen different approaches in the market from different traders where they're trying to find consistent small opportunities that they can find year round, and they'll trade every day, every week equally.
Yeah.
I've also seen other traders that say 80% of my profit comes from 20% of the year.
Yep.
So I need to either risk in and know when's my time to shine,
Yep.
and when it is my time to shine, I risk aggressively.
Yep.
Are you in the latter category?
Yes. I don't think trading is linear. I think trading should be just like the market. Periods of expansion, periods of money protection, periods of money management. That's how I trade. So when Tesla went up during the Trump election, I made $300,000 in like 2 weeks.
Sick.
And that's the opportunity to strike, right? You have to be ready for something like that. Not every day is an equal opportunity on the market. Like, I think that's a big thing that traders have, beginner traders have a problem with, is they walk into the day and the ES has traded within a 10-point range the entire day, and they think that it's the same opportunity as the ES trending 100 points in a day. It's just not the same. And so we need to be good at and gaining, and this is all experience, really. I mean, you can't learn this without sitting in front of the charts every day of your life.
Yeah.
And know when it's risk on, and know when you have to get heavy. This is an analogy that I make, which is probably one of the only analogies I like to make that goes to the casino with the markets. And that is, when a blackjack player counts his cards, they get a count of the table. So they know when the table's hot, they know when the table's cold. They count cards, they know, okay, the likelihood of this happening is very high. I need to increase my bet size, right? And that's how they get caught, right? Blackjack players that count cards get caught because they have erratic bet size. They go, okay, I'm back to minimum bet this time. I think the count's cold. It's hot. I'm going double bet size, triple bet size. And that's how they expand their winnings, right? I take that same approach to the market. When I think something is hot, when I feel like the momentum is there and the retest and the structure is very clean, I have to be getting aggressive. And an example of this is, I don't typically keep too much buying power in my account. Typically leave it around 200,000 is my typical buying power. This week, I've put money into my account.
Is that simply to stop you giving away gains in a cold period?
So there's a little bit of a personal reason to that. I'm building a home, and I want to make sure I'm safe with the capital that I have. So I've made a really healthy amount of profits so far this year, and that's been a blessing. And I want to make sure that money is paying off this home. I'd prefer not to take a loan on the home. Possibly, we're still figuring that out. So that's a little bit of a personal reason. But I do like to not have full buying power at all times. I like to manage that. And this week I put money into the account because I knew that I wanted to make sure I took full advantage of a move that I felt was very advantageous.
One of the worst feelings as a trader is investing hundreds of dollars in a prop firm, earning your way to a payout just to get scammed by the prop firm. And I'm sure most of you are tired bouncing from website to website, not knowing who to trust, what are credible sources of information, and what are just marketing campaigns by these prop firms to trick you into spending your money with them. And that's why I'm proud to bring to you a partner of the show, that is Prop Firm Match. Now, Prop Firm Match is a complete and comprehensive, trusted comparison website of all of the prop firms in the industry, where you will have verified reviews of real traders who are actually customers of the prop firm. And inside the website, you have multiple filters so you can categorize the search based on your own trading style, based on what parameters are useful and preferred for you. But beyond just that, Prop Firm Match has the best discounts in the industry for each listed prop firms, so you can get everything that you need in one place. So go ahead and click the link in the description to research the best prop firm for you and find the best prop firm discounts in the industry. So aside from this current market situation, which I'm agreeing with you is a little bit more obvious, but generally they're not so like black swan and then strong recovery situations. They're just, fundamental drivers, red folder events, or a little bit less volatile and less crazy and maybe less predictable. In hindsight, you could say, okay, that was the opportunity. That's where you load in.
Right.
But in the moment, as the opportunity is presenting, the market is cold and suddenly it's hot.
Right.
And there's a short window to execute. So in that short window, are you heavily relying on fundamentals, or are you reading technicals to sense the incoming liquidity volatility?
I would say I'm using this example because it's so short term that I can remember a lot. I think during big, when you say cold, do you refer to like downside coming in or
I'm
just
saying
sideways?
cold, just like more sideways. But even the black swan, just to kind of chime in on it, is black swan is not necessarily COVID and this tariff situation and going back to '08,
right?
Because there's election, which was a bit hot period. There's always actually something in the market that's
it seems like there's always something going on.
And you call it black swan, and you realize, well, that's just another quarter in the market.
Exactly.
So maybe it's just these micro move, or let's say micro black swan events. But are you basically finding market opportunity based on fundamental things, and then you reload up your accounts? Or how do you know when is the hot market coming in and when you should size in, as opposed to like, okay, or you wait for it to happen and then you're entering on the second leg?
Yeah, I typically, I don't think I'm too fundamentally driven. Okay. I think there's some obvious points where I think it's right to be fundamentally driven. I think it's proper to understand what's going on in the economy. Really, that's really as far as I take it, right? Like, you can't just be totally blind to what's going on outside of technicals. I think that's sort of irrational. I think you could still trade, but I think you're almost missing out on opportunity if you don't know what could be driving a move.
How long is your average trade hold?
I would say about 30 minutes to 45 minutes.
In which case,
when you average it, probably.
In which case, would fundamental drivers, which might take days, weeks, months to be priced in, on a kind of a scalp horizon, would fundamentals even matter?
I don't think it matters in the short-term move. I think it gives me confidence in the direction that I'm looking for, right? So if I know I have a bullish trend behind me, I will be more confident to create a bullish thesis on a short-term time frame off of a key break and retest of a previous day high, right? So a break and retest of a previous day high only works in a bullish market, right? If you're in a bearish market, the likelihood of a break above a previous day high, the likelihood is that that's a liquidity grab, right? And a total trap, right? There is such obvious periods in the market where it's what I like to call just a pop and fade. Pop and fade markets are some of the most obvious. I mean, I try not to use obvious too much because we have experience, right? So for the newer traders, right, it's not as obvious, but I hope that, traders can get to the point of reading this. When you're in a bearish market where you have a clear downtrend, the pop and fade is a beautiful thing to trade because you can almost start to read where those traps start to come in. Reading traps is definitely I would say another caveat to what I look for, right? How can I read where a buyer is trapped or a seller is trapped? So, for example, today on Tesla, it's a great example. Tesla had a very key 337 level, and we had what I like to call, what I think you probably know, inverse head and shoulder, right? So you have the first morning hold of that key level. Then maybe 20 minutes later, you get a break under it, right? And I actually lost on this trade today, so full transparency. And the reason, and we can talk about the reason why I lost on this trade. So we broke under that 337 level, and I tried to play the retest rejection of that level.
Okay.
So we broke under the morning low. I looked for the retest and rejection of it, right? And the reason that it didn't work is because the S&P 500 was still maintaining a strong demand level, right? So I'm trying to short Tesla off of a previous low a day when the ES and NASDAQ are still on equal lows, right? So that's a discrepancy. That's a trap, right?
Was this maybe a trade that you shouldn't have taken?
Yes, I should not have taken that trade. It sounds like
because at least just for the current context, everything's kind of bullish and we've just had a strong rally.
100%.
We're probably chasing all-time highs on everything, it seems, because this tariff dip was probably just a short-term fear in the market and we're kind of on the road to recovery. So just trying to short
which
was
wasn't
probably out
smart.
of your context.
Absolutely.
Okay.
So,
but let's get into it because even with experience and rules in place, it's easy to fall into traps. Well, that's why they're traps. Otherwise, no one would totally trade them or fall for them. What are obvious traps that it's just easy to fall for from beginner to experience?
So what I coined, I don't know if I coined it, but within our community, I've coined it, right? Is called the Big Four correlation, which is probably what most people would call an SMT. So when very often, if you're watching the S&P 500 futures versus the NASDAQ futures, very often you will see discrepancies on those moves. So you will see an S&P 500 take out the high, and you'll see the NASDAQ still under the high, right? So there's ES breaking the high, the NASDAQ's still under it. So you're having a divergence there. That is a very legible trap that you can start to watch. This is something I talk a lot about in the education I provide because this happens a ton. And if you get that S&P to break that high and that NASDAQ not, and you start to see the sellers come back in, after that ES fails back under that previous high, you can really aggressively look for a sell side trade.
Okay.
Because you're just left behind, let's say, 4 points of trap buyers above that previous high, where you could have, I like to call a trap that's you can read is not actually a trap, right? A trap that you can tell that it's a trap, is it really a trap at that point? It's a trap for maybe someone that wasn't watching the right thing, but I think most traps you can actually if you're with enough experience, you can start to spot. The Tesla trade, and that doesn't mean that I'm perfect and doesn't mean that I'm always going to not fall for it, right? So like when I review my trades, today I got trapped on Tesla. The ES did not make a new low. Tesla did. I shorted Tesla under the low. ES didn't make the low. ES bounced. Tesla bounced with it. Trapped. I was trapped, right? And I took a loss. But that was something I could have read, right? I could have said, okay, yes, Tesla broke that low. S&P and NASDAQ are still above the morning low. If we get a double bottom or a range hold at these lows and start to recover, Tesla's going to recover with it, right? And so that's why, again, like our beginning of our conversation was how important those futures levels are. Not going to always read it 100% correct. That's why we're all human and take losses. But that is why, and it's smart to understand, or it's good to understand why you actually were wrong or were trapped, right?
I want to get into this idea because this little analogy of a misfortunate moment in a loss today.
Yeah,
I think we can springboard off this because, as you mentioned, this divergence or SMT, it's a regular occurrence.
Yes.
And especially if you're reading the lower time frames, it's a few times in the day. And then the question then kind of is, what's relevant? Which ones do I give meaning to as opposed to just trading every little one of them? But then also when to overlook them, which at times you can be like, okay, well, I don't have the divergence, or I do have the divergence, but I'll take the trade nonetheless.
Yeah.
So what I usually do for myself is I have my Confluence list, but I give them weighting.
Yeah,
so
I agree.
Like an M1 BOS will not have the same weighting as another thing that I give more importance to.
Yeah.
So when you are building in your hierarchy and then you have certain things that are very repeatable, like this divergence, how do you add your either data to it or just intuition, discretion into it?
Yep.
How do you navigate things that are repeating, but not every single one has meaning?
Yeah.
And then overriding things and when to override them.
Totally. So I talk about this a lot, so I'm happy you brought that up. So if you, I don't know, PEMDAS is an old saying. PEMDAS is, it's like a saying in math where it's parentheses.
Oh yeah, in the UK we had big mass. Yes,
right.
Yes.
So multiplication, addition. So there's a weighting, right? What's important when you look at a math equation? What do you follow, right? So I do that same thing. At the top of that hierarchy, well, first of all, I don't typically trade the reversal of the trap. So just to make that clear, like I wouldn't trade if I saw a buyer getting trapped. I don't always actually trade that. That's not that high up the hierarchy of a trade that I would take. That's pretty low. I think I can read it. Probably could take advantage of it. It's probably a decent opportunity, but it's not something that I would always trade. And the reason for that is if we are inside of it, again, the biggest thing for me when I think of this is the range that we're trading in. So if we're in this tight range, right, or any kind of range, if you're trapping at the lows, you're still trading up into the range high. So you're still inside, right? If you're trapping the lows, you're going to trade up into the range high. So you're still inside of it. So the highest hierarchy for me is holds above or below a range. That's where I think the best opportunities arise.
And just to have clarity, ranges of what magnitude? Is it not an M1 range, but
probably like a weekly range.
A weekly range, okay.
Yes, typically.
And the range is defined by more than 2 touches?
I would say yes. Probably if we have a clean last few, I would say Wednesday to Thursday, I usually try to look at it over a week's period. If I get a Wednesday or Thursday to break a Monday, Tuesday low,
Okay, I see.
and I have a clear low liquidity below, right? So like this week in particular, we've gone straight up, right, and consolidated. So now I know I have low liquidity below where we just went vertical. So if we start to fall back into that low liquidity range and we have a rejection below the let's say Monday straight up, Tuesday, Wednesday sideways with clear lows, if we start to fall on Thursday under that Tuesday, Wednesday low into that Monday straight up move, right? I know I can target aggressively through that low liquidity area, right?
So it's interesting because I may be on the opposite side of the market to you.
Yeah.
And what I mean by this is when I see an expansion and then price consolidating, I'm seeing those intents in the market. Let's call it fuel in the market.
Yeah.
That fuel is dried up, hence consolidation.
Yep.
So the market is now going to seek new fuel, new buyers, new participants to then continue.
I'll look for the upside as well.
So what I'd usually do is
absolutely.
It seems like the range, you're waiting for the break out of the range
Yes.
and then the test to enter.
Right.
I'm more seeing what's the catalyst to get us out of the range. So I'm more seeing let's break below the range to come into demand, to come into discount, to then look for sellers getting trapped in and then buying through the range and then out the range and then maybe you joining me.
100%. I think I agree with your take as well. I will look for that as well. Like a deeper, I would have wanted a deeper pullback out of the, like, I don't want to long the range low. I'd like a deeper pullback before looking to long into that high. But I agree with you. I think if you're channeling higher, you want to see where the pullback comes in, right? Where people may say, oh, this is the high. It's time to short. But then we just have this is just a retracement that you can look to refuel that long.
In general, how would you, just let's say a mental exercise, when you have a market hitting a multiple times on the same level, we call it support. So we have 1 touch, 2 touch, 3 touch, and we see that there's just a consistent ceiling in price. The price came into demand, shot up, hit the ceiling, came back into demand, shot up, hit the ceiling again.
Right.
I'm seeing that as exhaustion. I'm seeing the buyers they don't have the force. There's not enough buyers in the market.
Totally.
So why are we going to break out the range now? Whereas let's say another perspective would be, we're accumulating orders on this level. We're building up power. We're pulling the elastic band back to then shoot out the range. Which side do you see yourself viewing the market?
For me, I don't try to guess too much into like what would happen next. I try to wait for the level to tell me, right? So if we're doing that in that example where you're hitting that high, coming back down, holding, hitting that high, coming back down, holding, I'm trying not to too much create a bias of like, okay, this should lead to this, right? I'm trying to just understand where that range is on the technical side, right? What are the levels that are clearly being in control, and let me attack when I can tell one side has lost, right?
The reason I ask is because let's say in this example, the support level, one person or myself, I'm seeing exhaustion. So I'm seeing weakness.
Yep.
So I'm anticipating price to shoot low, to grab a bit more fuel and then go higher again. Whereas the other view is, we're seeing strength. I'm seeing weakness. The other person is seeing strength. Right. So that person is going to be loading up buys on that support level. Yeah. I'm going to be getting out of buys and waiting for the level to break to then get into my buys. So these areas that we're defining as our ranges, they become quite key points or inflection points. And to come back to the point you mentioned earlier of, you can see break, test, and then it goes in the direction, or break, test, goes in the opposite direction and fails. Right. So these areas are pivotal because they lead to completely opposite outcomes.
Absolutely.
So just trying to understand, okay, how do we navigate what's going on here, just so that we are on the right side and not the wrong side.
Yeah, so I will always wait for it to be clear that a side has started to lose that battle in the consolidation. So
okay, how do you see that?
A break above, if you're taking the side of it being exhaustion and you're maybe positioning short because of that, if we squeeze above the high that you believe exhaustion is happening, which is usually easy to read because it's a very clear level that's been created, I will look for that break and retest and very strong maintain to then take my position. I don't want to be involved in that battle. I like to. Another thing I talk about is being a vulture. Vultures don't attack live prey. Vultures attack dead prey. And so I want to attack once I know someone is dead, right? Okay. Once the range has broken and the battle between whether it's exhaustion or support or strength dies off, when it clearly starts to flip and that retest starts to show something, I will attack, right? That's when I want to be. I try to take as much, not so much the word guessing, because you're not guessing, you're making educated decisions inside of those questionable areas on the market, right? I'm sure everyone has a good reason for why they're thinking that way, but I like to define where I actually think the trade will start to expand in a single direction. I really try my best to stay away from periods in the market where it's not a clear trend. I totally stay away from it. I think it's helpful for new traders to let a side start to develop before, saying, hey, we've moved higher into this high over the last few weeks, and I think this is where it should stop, right?
Yeah, you're picking tops.
I'm not gonna try to short until we fail under a previous high. Mm-hmm. So if you have your structure high that has broken out and created a new structure high, so let's say you have structure high here, structure high here, I'm not going to look to short this structure high until you've broken under this one and retest and rejected.
Got it.
Right? Because now I know that structure is gone. The previous structure is starting to become a new rejection. It's really sort of like a head and shoulder formation, right? You have your structure high, previous structure. I'm not guessing up here. If anything, I'm still going to look for pullback longs, right, in that trend to that previous high. But if we break that, then I know we've lost that structure, and I'm going to start to attack the reversal trade. So
you mentioned you're waiting for catalysts in the market, maybe fundamentals, or you're just seeing momentum in the market.
Yeah.
Whenever you see an established trend and you're looking for the break test continuation of that existing trend,
right,
you have a specific direction you're trading. Now, if you're entering all-time high territory, there's nothing on the left, so that's maybe a bit challenging. But when you do have price action on the left, you're going to have many ceiling levels. Okay, price might expand to that area. Do you believe in scaling out your position and partialing away, or is it kind of just wait for the break test, wait for a quick burst of movement, and just lock in a risk to reward?
So, I'm happy to get into this. So my strategy will always require scaling out. So what I like to do is once I get 1-to-1 on my position, I will take off roughly a quarter to almost half of my position and lock in the 1-to-1 basically. And I will use if this trade that I'm in starts to expand to, let's say, the next major supply that I'm targeting, I will allow my runners to go to that point. So I'm scaling out while the argument is typically that decreases the profitability, right? I've been around long enough to know how many times a trade has gone in my favor and then gone against me, right? Right when you start to say, oh, here it goes, right? Let's go. This is perfect. And you don't scale out because, oh, I'm going to continue to hold full size. That's when you go from green back to break even or red. So I am much more focused on the risk management side than it is just salivating over profits. It's about longevity in this game. It's about using these times to experience more and more, right? And staying in the game. Something that is, another thing I like to think about is riding a bike, right? You can't learn to ride a bike if you fall once and stop. So you have to stay in, you have to stay alive. And so I tailor how I manage my positions with that mindset. So if I take a break and retest, right, let's say off just $200, just using an arbitrary level. If I get a 10, usually it's around a 10 to 20% appreciation in my option premium. I will, because that's around, and we'll talk about stops later. I have a really interesting way of doing it. I will start to scale out of that position when it starts to hit like a 1-to-1 for me.
And by scale out, you mean sort of a trailing stop or
so
incremental?
I'll take, like, let's say I take 50 contracts. I'll take 20 off or 25
at
off.
the 1-to-1.
At the 1-to-1.
Okay. So at that point, at the 1-to-1, you're locking in, let's say, half your risk.
Yes.
And then the remaining 50% of your position size, how do you break that up? Is it one next level, or?
It starts to get, this is where trading starts to get a little discretionary. I've talked about this before. There is some discretion to that, right? So how strong is the ES look? How strong is the NASDAQ look? How much is the market still in my direction? Am I starting to see the S&P hit a key level? All right. If I'm up, like, you can't manage a trade, in my opinion, based off of just that individual equity. So if I'm long, let's say I'm long Tesla, right, and I'm up 12%, 15%, and I'm starting to think that this is going to continue higher, I've taken my scale offs, I'm in half my position. If I see the S&P 500 approaching a very known rejection point, at times there's discretion to it, right? I'll say, okay, I'm pretty confident that the S&P is going to start to fail here. I'm starting to see that. I still am holding half my position on Tesla. I'm out of Tesla. I'll try to anticipate it at times. Other times, depending on what I see on that S&P, I will try to continue to incrementally exit. And I like to get into a point where my favorite position to be in is where my remaining size on the trade, if I hit my entry point, is green regardless, right? So my job is to take that quick trade, scale as I get it, put myself in a position where the remaining equity I have in that position is irrelevant to the P&L of the trade.
Implying you don't break even your entry?
If it goes back to my entry, then if I've scaled out into the move, I'm still green on the trade regardless.
Meaning, say the partials secured offsets the loss taken
on the remaining.
Why not just put a break-even position in?
A break even on the I mean, it basically is a break. I'll
As in, it doesn't hit your stop loss. It comes back to entry. You're out the trade.
Okay,
but
yeah,
then
I get it.
You're plus 0.5 as opposed to break even because you hit stop loss.
So the way I view my stop losses, well, this is difficult with options. So this is something to talk about with options. So with futures, you can drag your line up to your entry point and stop out, right? Forex, you could drag your line up, stop out, set stops to break even, let it run, right? Very much a futures Forex type mentality.
How do you have it in options?
So you really can't do that with options, right? Because you could come down to that same level that you entered and be negative, right? Because of data decay and decay of the options, right?
But you got it tough.
Yeah, so like you could go up, right? Come back down to your entry point and be down, right? So how I take this guessing work out of it is when I enter a break and retest off of a key level, that is my invalidation line. That's what I like to call it.
Okay.
It must stay above this level for my thesis to be valid.
Let's map it out visually. So you have your consolidation zone.
Yep.
Let's say that zone is 50 points.
Yep.
And then you have your break, however impactful that was, test.
Yep.
When you're entering your test, it might be on the key level, maybe a bit below, maybe a bit above, but somewhere in that region.
Yep.
Is your stop now waiting for internal reactions and you're placing it at that test, or is your stop kind of at the low of the range?
My stop is the retest spot that I'm looking for it to hold. So
you're waiting for the test and then internal reaction in your direction, finding an entry covering that recent low.
Exactly.
Okay.
So let's say $200 rejection, break above 205, retest 200. I see some price action, right? I'm reading price action. I call it the target, like the battle zone. That's like the little incremental zone that you need to start understanding what price action is doing. So,
is it the same as what's on the higher time frame? Let's say an M1 consolidation break test, or is it just market structure?
I usually don't like the 1 minute.
Okay.
It's too, I think in my opinion, just too much noise. I think you'll have it's just way too volatile. So I like to look at the 2 or 5 minute.
Okay.
Typically on that time frame, you'll start to very clearly see some type of a low develop. So one of my favorite things to look for is a 2 minute candle to fail below the retest and then see it wick back higher above it.
Okay, interesting.
So you'll see it, and this is before I enter, right? I'm waiting for this to develop. I'm reading that price action. So the break is not my entry point. The break is like time to pay attention. Let's start to see, first we need a pullback, right? We're not going to chase breakouts. It's not a trading strategy. wait for the pullback, start to read price action. The best thing I love to see there is failure attempts lower, back under the retest, wicks back higher, wicks back higher, wicks back higher, right? I'm starting to understand who's in control here. If I've gotten enough data, in my opinion, 5 minutes, 5 to 10 minutes of data there, that's clearly showing me that the buyers are trying to hold above this key level.
Are you seeing that just through wicks, consecutive wicks in a specific area? Okay, and then let's say a moment of time has passed, 5 minutes, as you said. Is it just a market execution on the candle closure?
This is where discretion comes in. Again, it's never perfect. It's not like, oh, this is going to happen, and I don't want to say that to the viewers, right? It's not like, oh, this is exactly what you're going to see every time. It's going to be perfect, you know.
Because other times it just taps and goes.
Right.
It doesn't even hang around.
It literally taps and goes as quick as you even blink, right? It happens all the time. So the A+ ones are when it slowly pulls back in a controlled pullback, not just some kind of straight down drop. Slow pullback into it, start to sort of see that curl come back in, leave behind some trailing wicks under that are trapping sellers, right? And then a flag starts to occur, right? That creates a flag. And then once you get that break above flag, I'll take that entry point. So now I'm putting my stop loss, my invalidation at that retest level.
So I'm just trying to visualize, but this is a very small zone. We're on a M2, M3.
Yep.
So this rejection arc is going to be quite narrow, and just back to the initial breakout, just back to that high, let alone the whole move, just back to the high might be a 1 to 3, like it's a strong RR already in that internal push.
Yeah, could be.
If you're not covering the low.
Yeah.
In which case, are you not necessarily trading the full expansion? You're just trading the test and the initial reaction.
I will typically target that previous high, the breakout high.
I see.
I will target that high. That's typically a 1-to-1.
Does that not feel like it's a short-lived trade?
It can be. It can also be a monster. It could be the best. The reason I love trading that retest is that is possibly the best entry on an expansion period.
But you're already out before you get to feel the rewards of it, or is that why you kind of have your?
That's why I'm scaling.
Got it. Okay.
I don't like to fall for the mind games of you have to catch the whole move. I believe this is the best entry that you could take if this is going to work. If the thesis is correct that it's a break and retest long above this consolidation period high, this is the entry. There's no other, like, this is the one, because this is where it is holding and invalidating the previous highs. This is where it will all start. So I'm trying to get in because of risk reward reasons. I know that if I get in here and I'm correct, this will be the spot that I try to maintain.
As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data. And TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your backtesting tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need, the correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
When you are taking a partial so early, maybe protecting your downside, or a break-even formats, because you can't break even in the same way. But you've also taken out volume that could lead to a high risk reward in an expansive or aggressive move. Do you not feel like that's going to also toy with your psychology in terms of just what it could have been?
Yeah.
How do you navigate just an early partial?
I think that is one of the pain points, just to be fully transparent, that I still battle with slightly. There is a lot of moments. There's plenty of moments where I'm very right on the trade, and I sometimes regret taking so much off, right? Wishing I would have held further with more of the size, right? Not taking such an early partial on, let's say, half the position size. Absolutely happens quite a bit. The reason, or the way I cope with that is it heavily decreases my downside risk. It almost makes it to where I can't take large losses. It's just, and I will take that over profits any day. I think after experience in trading, someone that's actually done this for 12 years, you go through some very deep and very difficult times. It's not a game that you start to respect what you're doing. You start to respect the dangers and the uncertainties that the market provides. And I would 100% any day of the week protect my downside than try to expand my upside. It's just the way I think about it. I could be wrong, right? And and I would be totally open, and I could see how that viewpoint, someone else may say that's incorrect. I would agree, right? But
so the thing I'm maybe reading here is in the futures or forex market, you have the break even. So then your loss can, depending on how aggressively you break even,
right.
but you can very easily neutralize losses, or at least half your losses, just by aggressive break evens. Sure, you'll miss out on opportunities, but you won't lose money. In the options market, you're forced to take a partial to protect yourself. Does this ever creep into your mind of price action is price action? I'm reading the same markets. Why not change my vehicle from options to futures and not have to deal with these issues that you have in options? Maybe there's an upside I'm not seeing in the options market.
The upside in the options market is that when it moves in your favor, the expansion is greatly larger than you can make on a futures contract, right? You can make 200, 300, 400% on your position. And there's times where I will hold a position that long, right? If it continues in my favor. It's not like I'm totally killing the trade dead at 1-to-1. I don't want to make it seem that way. There's still plenty of size. Like if I'm taking, my normal position sizes are $50,000 to $75,000. Sometimes
taking half.
Yeah. So if I'm sitting in $50,000 and it's up 100%, that's still very good money for me, right? And I need to protect that risk, because if you start to expand lower, if a trade starts to work against you with an options premium, it will work against you quicker than it was working for you. Right. So I need to make sure I protect that downside risk, because if there's any by chance harsh rejection in the markets and things start to really unravel to the downside, you can go from up 50% to down 50% in 5 minutes.
Wow.
Right? And you need to be quick. So I think, to your question, is there downside of trading options versus the others? There is, if you don't understand the risks. And like I said to you earlier before we started, don't teach an old dog new tricks. I don't have interest in changing because I've been successful doing it. Do I see the advantage of the future side? Yes. Do I also see disadvantages? And just from my own personal experience, I do. And the problem that I've had when I've tried to trade futures, or I'm assuming Forex is similar, is the barrier to get into a position is literally zero, and the chance of overtrading is extremely high. Every time I've tried to trade futures, I have overtraded terribly, because there's no buying power, right? With options, for me at least, there's a limited amount of buying power on a day, which is a trick that I use to limit my ability to trade. So once I'm out of buying power on the day, I have to walk away, no matter what it is. With futures, as long as you have the margin, as long as you have the money in your account to cover the margin for a contract, you're in and out of that thing all day.
And it's exponential with prop firms, because then you have access to so much
just
leverage.
Reset it and
Can you talk me through maybe a recent big loss? I think I may have seen a video of yours which was tagline 75K loss.
I've taken a bigger loss than that.
Let's walk through losing annual salaries in minutes. How do you bounce back from situations, or how do you navigate that when it is your hard-earned money, not prop firm money?
Exactly. Yeah, so I was long Nvidia with a large amount of money, close to $300,000. And this could not have been a worse trade. It really irks me to this day. I think 2 days after I entered that position, DeepSeek, remember DeepSeek? That came out.
Yeah.
I was in $300,000 of Nvidia when that happened. Literally straight down. So I woke up, I think I was down $200,000 in overnight. Wow. How did I battle out of that? I continued to, I didn't get rid of the position. The reason for that is when you're down 80, 70% on an options contract, there's no reason to exit. What's the point of taking an 80% loss if you've already if you're comfortable with this, like I'm not trading money I can't lose, first of all. So if I'm down 80% on an overnight downside move, which I had no control of, why take that loss? I can only lose 20% more. So my focus switched to where can I recover? Where can I start to recover from this position? Where has Nvidia moved down into? What are the demand levels below? Where can I expect this to recover? And so over the next 2 weeks, I was strategically adding to that position, adding not to that position. And the reason for that is because options, once you're that far out of the money, it's not coming back. So if you're in a $150 call and the stock goes down 50 points overnight, the likelihood that 150 call is dead. I mean, it's literally dead money.
Before expiry, you mean?
Yeah, it's dead money. It will never come back unless it goes to like 200. I mean, it would have to go double what your entry point was to even get back to like break even.
Wow. Okay.
So that contract's dead. So I knew that. Throw it away. Don't focus on it. How do we build back from this, right? And that had to be, that was like the response I had to have. It wasn't like, oh, let me take this loss and just pissed off. So
in that state, people either you turn into fight or flight. It's
right.
like, let me fight this today, right now, and get as many entries and win it back today. And usually leads into tilt.
Yep.
Or I've also spoken to people that just get paralyzed, and for 2-3 weeks they just don't have the confidence to take any trade, even though good opportunities presented.
Yep.
With these both pulling emotions and probably both of them in your mind, how do you have systems in place to help yourself recover?
So thank God that loss came after years of experience of trading, because I knew what happened was not out of my wrongdoing. In maybe some regard, maybe, but could I have ever guessed that news was going to come out? No. I mean, it just wasn't possible. So I knew that if I stay calm, focus to what has gotten me to this point, I can battle out of this. And that was my response to that. And I would challenge, right, new traders to try to use that same mindset, right? You can't just pack up and leave. You have to battle and try to learn what's happened. Why did it go wrong? If it's something that, if it's in my situation, it's a little bit of like a freak event. And my focus was, how do I battle back from this? I used my technical analysis. I used my strategies that I always do, right? I focused on my key levels on Nvidia, my key levels on NASDAQ. I figured, okay, there should be an opportunity out of this. It's not like NASDAQ is going to go straight down overnight and continue straight down. There should be some kind of retracement move. So my goal there was let's not make it all back.
Just follow the plan.
But let's try to take advantage of the retracement that is very likely to happen. And there was a retracement, and I went from down 200,000 and I made 125,000 back on a long position from the lows. So I come out net $75,000 loss, but I think I did well to not run away and panic from that and just know and still what I know and battle back.
I've seen a lot of people reduce risk. They're like, okay, I'm not in the right headspace.
Yeah.
Let me cut my risk down. I can see the logic, but it also means your time of recovery is going to be way longer because each win is now smaller. And then keeping yourself in the pocket for longer maybe adds problems. It seems like you didn't cut your risk. You just followed the plan as it's supposed to be followed.
Yep.
Is there reasons behind that?
So if you're experienced and you know your edge, there is no reason to scale down. If you know what you're looking for and you know how to follow your strategy and your edge every day, I don't believe you should scale down. If you are a newer trader that is losing money because of, there's different reasons why people lose money in the market.
A valid
right?
loss versus an emotional.
A valid loss, if you're in a rut, but you're taking valid losses, maybe you're just reading something slightly incorrect. Every experienced trader goes through them. If you're someone that's been consistently profitable and you're in a rut, I would continue to battle through it. It's not like you've just overnight forgot how to trade. If you're a newer trader and you're taking irrational losses and you're putting yourself in a hole that's just out of comfort, then I think it's in the beginning of your career correct to like, hey, I'm trading too much size and I'm not trading correctly. I'm not learning how to trade or trading correctly because of emotions, because of account or position sizing, right? So that's, I think, a big problem. Let's say a doctor or a successful person comes into the world of trading. They have a few $100,000 saved up. They're like, hey, that's money I can use to trade. I've done well for myself. I'm going to go ahead and start taking let's say they watch a YouTube video that says take 20% or 10% of your account size in a position, they start taking $10,000 trades because that's the percent that they've learned online. That is so wrong. You can't be taking $10,000 position size as a new trader. I mean, you will not be able to manage that emotionally, right? So when I think that's when I would advise someone in that situation, certain situation where they haven't figured out their edge, they haven't figured out what they're looking for every day and built that established foundation, you need to do some type of a position size analysis, right? Are you losing because your size is too large and your emotion during the trade is just way off and you're not managing correctly because of a P&L number? If that's the case, try to continue to decrease size to where you can start to feel like you're relaxed in a position, right? Where you can actually see the technicals play out. Rather than I enter a trade, I'm instantly in panic mode because I'm I'm down to $1,000 in 2 minutes, right? Then panic mode enters. From that point, you're done from that point. I mean, once you enter that panic mode because of a P&L, it's over. The trade's over. I mean, it's a loss regardless. Whether you win or whether you come out on top in that trade or not, you've learned absolutely nothing from that position. It's just a total guesswork trade. So there's no structure behind it.
So with the life I live, pretty much every single month I'm in multiple countries. So with all that traveling, what that means is I always delay going to the doctor. And you know what happens when you start Googling your symptoms or asking ChatGPT what's wrong with you? It ends up looking like that small bump is 5 types of cancer and then you need to go to the emergency room right away. And I say all of this to say that you don't need to settle, and now the world has changed. But you don't need to waste your time or delay things or drive an hour and wait in queues, because when it comes to your health and finding the right professional, ZocDoc has got you covered. ZocDoc is a free app and website where you can compare high-quality in-network doctors and click to instantly book your appointments. From mental health to dental health to primary care to even urgent care, where you can find the specialist that you need at a time that suits you and take the call from the comfort of your own home, and even select filters like will they accept your insurance. So stop putting off those doctor appointments and go to ZocDoc.com/Titans to find and instantly book your top-rated doctor today. That's ZocDoc.com/Titans, ZocDoc.com/Titans. To wrap up the episode, you've done 7 figures in profit, more than a decade in the market. You've got a wealth of experience. What's the biggest piece of advice you'd give to a new trader?
Biggest piece of advice I'd give to a new trader is to not rush into, I know this is sort of cliche, but not rush into looking for money. You cannot come into this game looking to profit. You need to come into this game to really understand the inner workings of the market and why things happen on the market, and love it. You have to love reading charts, understanding why things are happening, building an understanding of why the market is moving in a certain direction. If you focus and come into this game because of dollars, you will lose. It's the dollars is a byproduct of your system. It's a byproduct of you following a structure, following a system that you've spent years curating and understanding, and you get money later in your career because you've done the right job of building your foundation. You can't build a mansion without a foundation under it. I mean, I think a lot of traders come into trading and try to build a house of cards, which is just a foundation of nothing, chasing dollars. And it's the sad thing is it's marketed that way. It's what everyone approaches this game for. I think you started to almost get a bad rep for what trading is. And it's almost like I don't even want to tell people that I trade anymore because it's just instantly like, oh, you're just a gambler, blah, blah, blah. And there is a very distinct difference between someone that loves trading, and I have extreme passion for this, versus someone that just enters into the markets for money.
I think like anything in life, you got to build the foundations first before
it's incredibly important. And after 12 years of trading, I have just, it's like there was one day where I just said, I can't believe how important the years of experience that I have has now started to show results. Like the growth curve is absolutely exponential. It's not like this. It's exponential. You'll go through, I'm reading a book called Atomic Habits, and growth curves actually are they go negative before they go positive. And most people will quit as growth curves continue negative before they hit that incline, you have to stay in the game. You need to not lose money that you can't afford to lose. You need to stay in the game during that period, build that foundation during that period, and that's really the only way you're ever going to see exponential growth.
There we go. Vincent, a wonderful episode. Thank you for your time and opportunity.
Yes, awesome, man. Thank you so much.
Good stuff, my man.
Yeah, you liked it?
Yeah, it was good, bro. That was good.